Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to another episode of Behind the Advice Australia. The topic today is repatriating to Australia, what every Australian expat needs to know. Now, repatriating to Australia is a major pain point for Australian expats. From a tax perspective, there are some serious tax traps. There's some timing issues, but there's also opportunities that can make a huge difference to your financial future. To unpack it all with me today, I've invited Tara Buchanan, who is a tax accountant and the managing director at Worldwide Advisory, who also specializes in working with Australian expats. How are you today, Tara? Thanks for joining us.
Yeah, no, I'm good. Thanks. Thanks for having me. I hope you're all going well.
Lovely to have you on the podcast. Love to just get a little bit of a background on yourself, particularly how you ended up working or specializing in working with Australian expats.
Yeah, so I come from traditionally a usual public practice firm. I was at my last firm for 15 years.
Right.
Had four kids and was wanting to mix things up a bit. And I've always been drawn to the complexities of international tax. Whenever they came across my desk over the years, I always enjoyed looking into those matters. And the rules around residency and cross-border taxes, they're pretty messy.
Mm-hmm.
And a lot of accountants don't get them right. So I decided that would be, I really loved it. That would be my niche.
Mm-hmm.
And, that alongside of self-managed super funds tends to be where I spend most of my time. A lot of clients, and especially a lot of high net wealth clients, it's a real struggle navigating residency, double tax
Totally.
treaties, offshore structures. And it's, the ATO compliance, the ATO are looking in this area more and more each day. So, that's the core of what Worldwide Advisory is about.
Sure. And I mean, it's a whole different ball game, isn't it? To, I guess, traditional tax accounting. And I find it's the same in financial planning. I think if you're
Yeah.
working with someone that's dealing with your situation as someone living overseas, they're going to have a better understanding of your situation, but also have that specialty as well.
Yeah, and at the end of the day, clients just want peace of mind. They want to ensure that who they're dealing with knows what they're talking about, and has that niche area, because there are so many nuances around this area that it really is a specialist area.
Yeah, absolutely. Absolutely. And tell us a little bit more about Worldwide Advisory and I guess how you support Australian expats more specifically.
Yeah, so I guess, bringing it back to why I do it. So it's the variety and the people. No two cases are the same.
Mm-hmm.
I enjoy working with those who, there's many reasons why people move, overseas and become expats of Australia. So they could be moving for work, for lifestyle, family, opportunity. Um, no two cases are ever the same. And as I said, there's a lot of nuances around that. Um, I like untangling the real complex situations and cross-border issues.
Mm-hmm.
But even more, I do love seeing that relief on clients' faces when, you've reassured them and you've figured out their situation. And as I said, like my biggest aim and motto is giving people peace of mind and being able to sleep at
Mm-hmm.
night. And I need them to feel confident and in control when they're living abroad.
Totally, totally, and I can relate to that. I think there's so much information out there that Australian
Yeah.
expats can kind of come across, and some of it maybe there might be good intentions with the information that someone has received from a friend
Yeah.
or colleague, but if it's not specific to your circumstances, it can have have the reverse effect, like leave you in a worse position in some instances.
Yeah, and getting the right advice up front's, imperative because untangling that web and that mess is often more expensive than, the initial advice and doing things correctly the first time.
Exactly. I couldn't have said it better. And worldwide advisory, you're working with expats across the globe. Do you have like I guess, an area of the world where most of your clients are concentrated?
Really, no. So, we assist expats in every stage. So when
Hmm.
they leave Australia, or, preferably before they leave Australia, ceasing their tax residency and making
Hmm.
plans around that. Um, while they're overseas, so, if they've got Australian income that still needs to be declared, HEX
Hmm.
debts, managing things such as directorships, looking at permanent establishments if they're overseas and they're wanting to do business in Australia. But also, um, as we will discuss a bit more, it's that returning home as well is, there's opportunities around timing the residency, dealing with the foreign assets and minimizing the tax surprises.
Absolutely. And I think when we're thinking about tax planning, there's so many different directions we could go in our
Mhm.
discussions. So in today's episode, we want to try and just focus on we're going to try and focus on the element of returning to Australia
Yeah.
and what happens when
Yeah.
you repatriate, what happens to your overseas income, your assets. So Tara and I are going to get into the nuances of that. Just generally, Tara, like if you think about tax planning for Australian expats, why is it so important for Australian expats who are planning to repatriate?
There's a lot of reasons why it's important to, I guess, get advice around this. And a lot of people, there's a lot of misinformation out about when you do become a tax resident again. Um, it's substance over form with the ATO. And look,
Mm-hmm.
in most cases, when exiting and coming back into Australia, you are either ceasing or becoming a tax resident when you hop on the plane and either leave or come back. Um, the day that you re-establish tax residence in Australia, the ATO will tax you on worldwide income. So it's very important to kind of establish that date.
Mm-hmm.
Um, and so you can report the correct income with the ATO. Um, without the forward planning, without seeking advice, you can easily fall into the traps of potentially double taxation, miss the chance to reset cost bases,
Mm-hmm.
um, and potentially trigger unexpected tax bills on things such as overseas properties, investments, pensions, and things like that. So I always suggest that people, before they arrive and to ensure a smooth transition, seek that advice early and not once you're in the country.
Yeah, absolutely. And you touched on a few different aspects of clients' financial situations there. Are there, what would you say are some of the more common, I guess, tax mistakes that Aussie expats make when they're coming back to Australia? I think you mentioned, their overseas properties in some
Yeah.
instances, they might not necessarily report transactions relating to that account correctly. What are some more, I guess, common tax mistakes?
Yeah, so you're spot on. The biggest one is overseas investments. So the time that they've spent overseas, they've accumulated wealth, investments, and when they come back to Australia, the misconception that, well, it's overseas, it
Mm.
doesn't affect me here. But um, Australia has a residency-based tax system, so the ATO will tax worldwide income. Now, where people get, I guess, misinformation or confused is where they go, oh, there's a double tax treaty. I don't need to report it. It's handled under the double tax treaty, and that's not essentially correct. The double tax treaty is there to, um, I guess, what's the word? Stop the double taxation
Mm-hmm.
of income. But just because there is a treaty doesn't mean that you don't have to report the income. The treaty in some countries covers for who has the taxing right and things like that, but you need to look at the nuances of the tax treaty to ensure that you're reporting the correct income.
Yeah, absolutely. And I think it's so common for Australian expats that they accumulate a basket of different assets while they're overseas, right? Like you've got foreign
Yeah, they do.
pensions, real
Yeah.
estate, shares, cash. And what's confusing is there's usually different tax considerations on those assets when you come back to Australia. So
Yeah, there is. Yeah.
yeah, I think we'll get into the exact kind of tax considerations for each of those later on in the episode. I just wanted
Yeah.
to ask you more broadly. So if you've got an expat that's thinking about coming back to Australia in the next, say 2-3 years. That's kind of their tentative time horizon. When's a good time for them to start thinking about their tax situation before moving back home?
I generally like to have a conversation about 6 to 12 months before they're returning,
Yep.
particularly where there's structures set up overseas. They really need to be dealt with, restructured, wound up, whatever is appropriate in that situation,
Mm-hmm.
prior to coming back to Australia. Because the minute they come back to Australia, the ATO will look at, where that foreign trust company is actually being managed. Then we go down the central management control.
Mm-hmm.
Is it an Australian foreign trust? Sorry, and a foreign trust in Australia, and things like that. So if you leave it until after you've landed back in Australia, it's too late to kind of
Mm-hmm.
put into place any of those tax planning strategies.
Yeah, and I would say it's the same for me as an advisor.
Yeah, okay. Yeah.
Like for existing clients that are planning to come back in 12 to 24 months, we want to have like a robust discussion around what that plan looks like, at least 12 months in
Mm.
advance. That way we've got ample time to make decisions, because some things take time to kind of unwind or divest. And then usually you've got the ability to kind of manage your tax outcomes over different tax years as well,
Yes.
in some instances. So there can be some, I guess, some tax savings there to that can be created just by having that time in advance to plan.
Yeah, and that's right, and especially if you know when you come back to Australia what your income levels will be. For example, I've got a client at the moment who has a Canadian pension, and it really makes no sense to withdraw it. Now
Hmm.
it makes sense. Like they've just come back to Australia, they plan on cutting back to part time in a couple of years, and that's really, from a tax point of view, where they will get more bang for their buck in terms of the ATO not capturing as much tax.
Yeah, absolutely. I think an area, and if we kind of change gears now, an area of, I want to say not confusion, but there is a lot of information out there around Australia's tax residency rules. And I wanted to chat to you about how these kind of work when Australian expats return to Australia. So, how does kind of the ATO determine that someone is a resident for tax purposes again when they arrive back in Australia?
Yeah, and you're right. It's there's a lot of information out there. There's a lot of misconceptions that, um, there are some draft rulings out there and some things that may come into place in the next couple
Hmm.
of years, but they're not in force at the moment. The big thing with the ATO, they look at, the facts and circumstances, so not dates. So as I said before, generally you fly out of Australia, you cease being a tax resident. The date you fly back in, you're a tax resident. But the ATO really kind of look beyond that, and they look at, what are your intentions. The ATO
Hmm.
is massive on intentions, and just because you're doing something on paper doesn't mean you're actually living that life. The ATO will look at where your home and your family are,
Hmm.
where you work, where you earn your income, how long you plan to be in Australia. Is the big one, because some people kind of come back and go, oh, I'm just going to come back, establish tax residency, sell my property,
Hmm.
and then leave. And there are some situations where the ATO might go, hang on, that's actually not, you're not an Australian tax resident because that wasn't actually your
Exactly.
intention. Um, and the biggest thing, and where we kind of come in, is there's no single factor that makes you a tax resident or doesn't make you a tax resident. It's the ATO looks at a bunch of factors that are financial based, but also social and living based, that kind of drive that determination of whether you're a tax resident and when you become a tax resident.
Yeah, absolutely. And a lot of those factors and considerations that you mentioned are kind of within that resides test. I think that's usually
Yeah.
the main one that captures most Australian expats when they return to Australia.
Mm.
And in most cases, the day that they arrive back to Australia kind of sees them as a resident for tax purposes again.
Yeah,
And it's
definitely.
quite clear that they're a resident again based on their intentions, because they usually have new accommodation lined up for them, whether they've just purchased a property or they've got
Yep.
they've just leased a property. They're going to have employment here in Australia, so it's quite clear to see what factors are kind of making this person or this individual a tax resident again, as opposed to
Yeah.
someone who's back on more of a transitory basis where they're just visiting family, spending some time with the family, and then heading back overseas. So there's that quite clear demarcation there when they do arrive back in Australia.
Yeah, there is, and there's, as you said, there's a massive difference between getting a 12-month lease on a house in
Mm-hmm.
Australia and getting, Airbnbs or hotel stays in Australia. The ATO would look at that and look at the intentions behind that, and they obviously show two very different intentions.
Yeah, absolutely. And I mean, is there, like, for you as a tax accountant, ultimately you're the one that kind of oversees the tax return, and in that tax return is where the Australian expat will indicate, yes, I'm now a resident for tax purposes again on this date. Is there any flexibility there? Where they can kind of uh, set out a different date that they're becoming a resident, which may be different from the date that they've arrived back to Australia.
It really comes down to, yes, there can be a strategy, and you can kind of plan around that.
Mm-hmm.
It's tied, residency is tied to when you actually resume living in Australia, not just a flight date, as we've discussed. So,
Mm-hmm.
um, yes, it would be easier to kind of fly back on that 30 June, 1 July for a
Mm-hmm.
clean cut tax year, but that very rarely happens in practice. Um, that would avoid the part year returns and things like that. But
Mm.
if if you're flying into Australia, you've got that 12-month lease and things like that, you can plan so that when you do arrive in Australia, you've got the lease in place, you've got a job, you've got, all these things are lined up
Mm-hmm.
that you can plan your arrival into Australia to kind of suit your circumstances.
So you can kind of be a little bit more, in some instances, you can be a little bit flexible around what date that residency actually resumed. It doesn't necessarily have to be the date that the flight landed. It could be something else where it might be the date you move into your accommodation if you're in hotel accommodation for the first couple of weeks or something like that.
Yeah, even if you're in hotel accommodation for the first few weeks, if that intention was always to stay in
Mm.
long-term accommodation, the ATO will generally have it from the date that you did arrive in
Yeah,
Australia. It
yeah,
would be more about, it's really about cutting those ties where you've come from, and showing that intention of staying here long term. And as I said, it's not all financial based with the ATO.
yeah,
They really do look at your living situation and how you live your daily life.
totally. Is there any opportunities there? So is it better? Like, are there any opportunities where if an expat returns to Australia on the 1st of June rather than arriving on the 1st of July, is there anything kind of anything beneficial to doing that?
All that would do in that case is really stop that split year
Yeah,
tax return, because our tax years don't often align up with other tax years in other jurisdictions anyway. As I said, I very rarely see people kind of come in on 1 July.
yeah,
It's not really seen. Um, a lot of people, there are a lot of people who are living overseas and ready to come home
hmm
to Australia, repatriate. But I've got one client at the moment who just wants to come home but is waiting for crypto to drop,
oh, right,
because
okay,
it's because and for this particular person, it comes down a lot to whether they took up the deemed disposal when they exited and things
hmm
like that. Um, but yeah, like you can plan it on, the investments, the prices. With crypto, it's
yeah,
very volatile. Um, just timing, yeah, when they kind of come back in or when they leave and things like that. There are some people who kind of, sit there, not at the airport, but, just sit in the waiting wings and wait
yeah,
for the price of their assets to be, I guess, favorable to them. Um, and are ready to come home.
yeah,
And that's more applicable to people who have been overseas for 10 plus years, where they
yeah,
clearly haven't had an Australian tax residency in a long time.
sure.
Um, you know, yeah.
Yeah, some really interesting insights there. Just waiting for assets to kind of fall in value before coming back. That's kind of
Yeah,
dictating
actually, I
the
think
pace.
I should have said increase in value. Sorry, I did say in fall in value. I was thinking going out, but yeah. So
Yeah,
the cost base when you come back to the
you want it to be
country,
higher. Yeah,
you
right.
want it to be high. Yeah, you
Yeah,
want it to be higher, because that's the resetting of the cost base for
totally.
impats. Yeah.
Yeah, I wanted to ask you as well about the tax-free threshold that we have here in Australia. So it's quite unique with the tax-free threshold. If you aren't in Australia and you're not a resident for a full income year, you get a partial tax-free threshold. So there is, and this is something I've kind of worked with a few of my clients on. They arrive in Australia in June and they get a partial tax-free threshold, which is I think it's 13,000 or 13 or 14,000,
Yeah,
which is
less
pretty
than
good.
the
Like that's
18,000. Yeah.
a large proportion of the tax-free threshold. And then it kind of gives them like a small window where if they've got some form of taxable income in Australia, they've got a high tax-free threshold of 13,000 before it kind of resets in July of the
Mm-hmm.
next year. Obviously, it's got to depend on the client's personal circumstances whether or not they can actually utilize that tax-free
Yeah.
threshold.
Yeah.
But I thought that was kind of an interesting, where clients do have that flexibility to come back in June or July. It might be something
Yeah.
that they
Yeah.
could
Yeah.
employ.
Yeah, look, definitely there, particularly where there is that, the Australian income in that last portion of the year as well.
Yeah, absolutely. We kind of touched on different like expats collecting a basket of assets while they're overseas. Shares, property, Australian property, foreign property. Love to just kind of get your expertise and insights on some of the tax implications for these assets held overseas when they arrive in Australia and become a resident for tax purposes again. So if we look at shares, for example, you've mentioned deemed acquisition, where there's that cost base reset a couple of times. Do you maybe just want to give a high level in terms of what happens with shares and how that deemed acquisition and cost base reset kind of works?
Look, simplistically, when you become a tax resident of Australia, the value of all investment assets held at that time, the market value of those assets at the time you start being an Australian tax resident is the cost base. So a lot of people, and this is where some errors have come up, people lodge their tax return when they sell shares and they think their cost base is what they purchased the shares for originally while they're overseas. But that's not actually correct. It's if you purchase the shares overseas in your time overseas, you come back to Australia, the cost base is the market value of those assets at the time you become an Australian tax resident again. Um, doesn't apply for if you're overseas and bought Australian property. It doesn't apply to Australian real property. But,
Yep.
um, you know, talking about foreign properties or shares, units and things like that, the date that you were deemed a tax resident of Australia again for those investments purchased while you were overseas, that cost base is the market value at the date of tax residency.
Yeah, it's really interesting, isn't it? So that applying to shares and foreign property, and it's really important to keep good tax records, right? Like you want
Yeah,
to have if we look at property, for example, it's a good idea to get a evaluation done on
yeah,
the date that you arrived, or I guess the date that you became a resident for tax purposes again. And
yeah,
then for shares as well, you want to, of course, keep some accurate records of that as well. And with
yeah,
several of our clients, particularly those that are on, I guess, Australian platforms, with their shares, their cost base will reset when they arrive back in Australia. We can actually update the cost base on the platform itself so
yep,
that all of the tax records are actually correct, not just
yep.
from our own personal records, but on their accounts as well. It's correct. So I
And
think
that's, yeah,
that's
yeah, that's exactly right.
yeah, I think that's a huge thing to keep in mind. Otherwise, comes
Yeah.
tax time, they're going to come to you and say, you're going to ask them, what's the cost base? Like, do you have any records of this? And, these are shares that they might have purchased,
Yeah, and
3 or 4 years ago.
yeah, and even more complicated than that, which I think we touched on earlier, was if those shares were held when they were a tax resident years ago, when they leave, there's the concept of deemed disposal. So,
Yeah.
which as an individual isn't compulsory. If it's a trust, there's a compulsory deemed disposal. But for an individual, the cost base, if you had those shares when you're an Australian tax resident, it may not be the market value when you come back into Australia if you didn't take up the deemed disposal when you exited Australia. So, yeah, there's a lot of nuances and things to be careful of, and that's where financial planners and accountants work well together in terms of keeping those records aligned so that the tax
Yeah.
results are accurate.
Yeah, absolutely. It needs to have that history
Mm,
and understanding the history of the
yeah.
shares. I think what I also see with the Australian expats that come back to Australia with shares, uh, they have that cost base reset on the
Mm,
day that they arrive back in Australia, and then they might sell those shares maybe 8 or 9 months
mhm.
after arriving back in Australia. They think they might be afforded the 50% capital gains
Yeah.
discount on
Yeah.
on any gains that they've made since they arrived back in Australia. But the holding period, the 12-month holding period, also takes effect from the date that they resumed tax residency. So that's another one that I see come up from time to time as
Yeah,
well.
okay. Yeah, yeah, no, definitely. And again, it just shows that importance of seeking advice before you do something, whether that be before leaving Australia, before arriving back in Australia, before selling an investment.
Absolutely.
Yeah, it really highlights the importance of that.
Yeah, absolutely. I mean, we've touched on capital gains tax. Are there any capital gains tax consequences when someone just becomes a resident again? Does anything happen to their assets when they just return to Australia, they become a resident?
Not from an Australian tax
Yeah,
perspective, from the jurisdiction they've come from, most likely, depending on what jurisdiction that was. But simply coming into Australia, that doesn't trigger a CGT event in itself. It's what happens after that with those assets. As you said, selling, whether that be 8 months or 13 months later, that's when the tax implication is.
yeah,
But it's that underlying importance of resetting the cost bases at the time you become a tax resident. That is important, but there are no CGT tax implications at that time you commence being an Australian tax resident.
sure. It's just when you realize the gain. So when you're selling
Exactly.
the assets.
Yeah.
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 Let's kind of move into a more, I guess, a bit more of a tricky area, which is foreign pensions. Again,
Yeah.
it's a kind of another type of asset that our clients are accumulating from their time
Mm,
overseas. It might be they're in the US, they might have a 401k or an IRA, an individual retirement account. Singapore have their compulsory pension plans.
yeah.
Canadian RSPs. There's a whole range of different retirement accounts that expats pick up on their time overseas. How are these kind of broadly treated from a tax perspective? Let's just look at it. They come back to Australia. Does anything happen from a tax perspective on those retirement accounts?
Generally, not until, so on these retirement accounts, generally, I'm going to say that very
Yeah,
clearly, generally, there's no tax implications until those funds are drawn down. Even if they're tax free overseas, doesn't mean that they're tax free in Australia.
yeah,
You still have to declare them because, as I said, in Australia, we've got that worldwide, you know, um, declaring of income.
yeah,
Where it's a bit different again is where kind of the treaty steps in. So with the US, for example, the 401ks, yes, we have to declare in Australia and pay tax on, but their social security doesn't get declared in Australia. And things like that. So again, it comes back to there's a lot of nuances. Read the treaty, and yeah, find out kind of where things sit when whether they're taxed on the growth in a year, whether
mhm,
they're taxed on the growth at time of drawdown, whether
yeah.
they're taxed on the whole amount drawdown. There's
That's
yeah,
right.
a lot of nuances.
Yeah, because it's a question I get a lot. Is they're taxed on the year on year earnings in Australia of these retirement accounts? So generally not. It's just when you're
Yeah,
making withdrawal.
generally.
That's when you need to think about some tax planning opportunities. And just as a financial advisor point, I get a lot of queries about can these retirement accounts be moved into superannuation? Can they be rolled into Australian super? Now, generally, the answer is no, because essentially they don't meet this definition of a foreign super fund. There's typically only one or two kind of foreign funds that you can actually move into super, which is the UK pension plans, and then
Yeah,
the New Zealand Kiwi Savers as well. There's
yeah,
that cross trans Tasman kind of arrangement there. So with the exception of those two, most other retirement accounts they must be withdrawn and then they
yeah,
must be contributed
yeah.
into superannuation. If that's what you're looking to achieve, then that's kind of the way it has to be done. So there's going to be tax implications when the funds come out, but then also you need to be mindful of your contribution limits, kind of getting
Mhm.
those funds into super as well.
And I guess where you might have some, opportunities, and correct me if I'm wrong, is say they don't have over 500,000 in Australian super, they withdraw from the overseas pension fund, 100,000, they've got unused caps. Is
Mhm.
that kind of where you could have the, yes, assessable income coming in, but the full deduction kind of going back out? So it's a nil tax impact if they've got that from an individual level, of course, not in the super fund because it'll be taxed at 15%. But is that kind of a strategy that can be used?
Yeah, absolutely. So you can make some quite large tax deductible concessional contributions
Yeah.
to your superannuation fund these days using what's called the catch up or the carry forward contribution rules, where if you haven't contributed for quite a long time, like generally the last 5 years, you can use that unused cap or limit that you didn't use up in the last 5 years and kind of use that in the current financial year.
Yeah.
So that can
Awesome.
be
Yep.
a really effective strategy to look at getting some
Mhm.
funds in super, but also reducing your taxable income here in Australia.
Yep. Definitely. That sounds good.
So we touched on some tax planning strategies. Are there any kind of tax planning strategies that kind of come to mind that expats can look at before returning to Australia?
Definitely, especially where you are eligible to withdraw in the jurisdiction you're coming
Yep.
from, in a tax-free environment, doing that prior to leaving. And again, it comes back to seeking advice 6 to 12 months in
Hmm.
advance so you can plan that. So, the tax-free saving accounts in Canada, for example, withdrawing, if you're eligible, withdraw from those accounts before you become a tax resident, because if you've got that in cash and you come into Australia, there's no tax implications on. Actually, you can't sell cash. There'll be interest
Yeah.
on it, which Australia will capture. But yeah, it'll be, that drawdown in itself wouldn't be taxable in Australia because it happened while you're a non-tax resident.
Yeah, absolutely, and it kind of comes back to those timing opportunities that we talked
Yeah.
about in the intro, and you can potentially make a tax free withdrawal in your host country tax jurisdiction, which won't be taxable in Australia because you're still a non-resident for tax purposes, and doing something with those funds in the whether that be a year out or 2 years out from returning to Australia versus coming back to Australia, making the withdrawal at that point in time, it's going to be
Yeah.
taxable in Australia. So there are absolutely
Yeah.
some planning opportunities there.
Yeah, and look, I see cases where it is too late. They are already back in Australia, and it then comes down to, the timing of the withdrawals and the foreign tax
Yeah,
credits available, and things like that, as to how to minimise tax implications. But at the same time, these people want their funds for a
yeah,
particular reason, and you can't avoid. There's no tax planning, options there. Um, but yeah, it kind of really comes back to planning prior to coming back to Australia.
yeah, absolutely. And when it's when they're already back in Australia, the main strategy you can kind of look to employees. You take out withdrawals periodically over different income years because that
Yeah.
reduces the tax hit. But as you said, some people just want to have access to all of it. They just want to square away that or close out that retirement account, focus on their Australian side of things. And in that case, there's not a lot of options. But we talked about the super option before, where you can make a tax deductible super contribution. That's one way you could look at reducing the tax impact here in Australia.
No, definitely.
If we think about the ideal, I think we touched on this a little bit earlier, but the ideal time to start tax planning before repatriating, it's 18 months kind of out, ideally.
Yeah, look, from my perspective, no less than 6 months.
Yeah,
And that's even just for inverted commas the simple individual who holds investments. But as you said, the 12 to 18 months for those who have got entities and structures set up abroad that may need restructuring prior to moving back to Australia. It's yeah, it's as I said, it's too late once you're in the country. The tax planning opportunities have kind of gone out the window. That ship has sailed.
yeah,
So it's really important to seek that advice. The six, at least 6 months, but if more complicated, 12 to 18.
yeah, absolutely. I think just to kind of round out this this conversation, are there any kind of easy things that Aussie expats can do to kind of make the tax burden or make the tax effect of returning to Australia a lot less, we'll make it a lot more streamlined, a lot more straightforward? Is there something that Australian expat can do that's quite easy themselves?
Yeah, so, realizing gains while still a non-resident is
Yep.
one. Withdrawing, as we discussed, those pensions while overseas again is another. Um, Prior to coming back, cleaning up the offshore bank accounts and things like that. Dealing with the structures prior to coming back. It just makes things, once you're back in Australia, a lot cleaner. But again, it kind of borders on that. Well, you should seek financial advice, because does that
Yeah.
align with, just because you're saving tax doesn't mean it aligns with your financial goals and wealth strategy. So that's kind of where I really enjoy working with financial planners, is ensuring that saving tax is one thing, but
Yeah.
wealth creation is another, and you've got to ensure that both align. Um, and the other thing is, any assets that you do retain, particularly foreign property,
Hmm.
arranging the valuation and that before you leave. So obviously not the 6 to 12 to 18 months beforehand, but before you leave, kind of go, I need this valuation done. I'm leaving 12th of December. Can you please arrange a valuation to be done around this time and get it notarized and put into English if required, so that that's there, and just to have it on record for when that property sells.
Yeah, absolutely. It's just going to make your first tax return back in Australia that little bit, or that a lot more simple, streamlined, versus a lot more complicated. It's probably a little bit more costly to kind of look at getting valuations done later down the track as well, like historically. So yeah,
Right.
some really great tips there. We might round it out there, Tara. I want to thank you so much for jumping on and providing your insights. It was great to have you on the episode.
Excellent. Thanks for that, Mitchell. I'll talk to you soon.
Thanks, Tara. Take care. And see you guys in the next episode. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.